I have one rule I almost never break. No speculative long calls. No buying options. No pure directional bets with a hard expiration date. I'm a wheel strategy guy. I sell covered calls. I sell cash secured puts. I collect premium and reduce my cost basis. That system helped me build my account to $90,000 at 19 years old. So when I tell you I just put $31,000 into long calls on a single stock, I need you to hear that as the exception it is. 126 contracts, $30 strike, July 17th expiration. The stock is better. Better Home and Finance. It's down 40% in a month, and before you think this is reckless, there's one number in this video that explains exactly why I made this move. I'll get to it in about 4 minutes. But first, let me show you what I actually own. Here's what we're covering today. 1. What actually happened to Better, and why most retail investors are misreading the sell-off. 2. Why the new Better is a fundamentally different business than the one the market is pricing. 3. The exact trade, every number. The specific scenario I need before July 17th. 4. The honest bear case. What could go wrong, and why I sized this so I can afford to lose all of it. 5. The exit plan. Because discipline inside a speculative trade is still discipline. The big question, is this gambling or a calculated bet on mispriced fear? The answer depends on one specific thing happening in the next 6 weeks. I'll tell you exactly what that is and what happens to my $31,000 if it doesn't. If you've been watching the markets over the past month, you know rates have stayed elevated because of the Iran conflict. That situation created a ceiling on rate cuts. When rates stay elevated, mortgage demand drops. First-time buyers wait, refinancers wait, home purchases get deferred. That's the direct line from geopolitics to Better's business. And the market punished Better hard, down 39% in a single month. Now here's the part most people are getting wrong. They're selling Better because of the macro environment. But Better's Q1 2026 numbers were actually strong. Revenue up 52% year over year, funded loan volume up 89% in a single quarter. 89% loan volume growth, and the stock is still down 40%. The CEO said it directly on the earnings call, a huge reservoir of pent-up customer demand that while it may hesitate to lock and fund immediately now due to the uncertainty in the Middle East and elevated rates, it will unlock into massive volume and revenue growth once things settle down. That demand doesn't evaporate, it defers. The people who want mortgages are waiting, not gone. The sell-off is exogenous, the business didn't break. The fear price didn't change. That distinction is everything. Here's what most retail investors think Better is: a digital mortgage company getting crushed by high interest rates. That's only half the story. Think about what happened to Shopify versus individual retail stores. Shopify stopped being a store and became the platform that powers every store. Better is trying to do the same thing in mortgages. Stop being the lender. Become the infrastructure that powers every lender. Their Tinman AI platform doesn't just originate mortgages. It powers other companies' mortgage businesses. Credit Karma, 140 million members, doesn't have a mortgage division. They have Credit Karma Home Loans, powered by Better. A top 5 non-bank mortgage originator just went live on Tinman. A top 3 personal lending fintech is in pilot right now. In Q1 2026, 50% of Better's $1.64 billion in loans came through this B2B platform. That number was almost zero 18 months ago. Year-over-year growth on that channel, 404%. And then there's this. Better and Coinbase just funded the first Fannie Mae-backed Bitcoin mortgage in U.S. history. That's not a gimmick. Fannie Mae approval means these loans are eligible for the secondary mortgage market. It's going nationwide this summer. The market is still pricing Better as a rate-sensitive direct-to-consumer lender. I'm buying calls because the platform story is barely priced in. That gap between what the market thinks Better is and what it's actually building, that's where this trade lives. Real quick, if you're finding this useful, hit subscribe. I break down real trades like this every single week with the actual numbers on screen. Now, back to the trade. Here's exactly what I'm doing with my money. 126 call contracts, $30 strike, July 17th expiration, $2.47 per contract, total cost $31,000. This is not my normal move. My normal move is selling options, collecting premium, running the wheel. I'm a seller by philosophy. So why am I buying calls this time? One number, 4 ranked 11%. 4 ranked measures how expensive options are right now compared to the past year. 11% means options are almost as cheap as they've been all year. Here's the analogy. Buying options when 4 rank is at 11% is like buying car insurance after a full year of perfect driving. The insurance company prices you as low risk, so the premium is cheap, but you know you're about to drive through a winter storm. I'm buying cheap options on a stock sitting on a technical support floor. 40% of macro-driven fear is already baked in. I'm waiting for the storm to pass. Let me walk you through the scenarios. If BETR stays at $25 at expiration, I lose nearly everything, about $29,862. If BETR hits $28 before expiration, the calls are worth around 80 cents. If BETR hits $29 before expiration, calls worth around $1.50. That's when I'm selling. My break even at expiration is $32.47. I'm not waiting for that. I'm targeting $28 to $29. I sell before expiration while time value is still in the contracts. I don't need BETR to be above $30 for this to work. $25 is my line in the sand. The stock has bounced off that level multiple times. That's the technical floor I'm watching. I'm not going to skip over the risks. The bears are not wrong about some of this. BETR's financial health is genuinely weak right now. Last year, for every dollar of revenue BETR generated, they burned a dollar of operating cash. Revenue, $164.9 million. Operating cash flow, negative $166.6 million. Their Perotrosky F-score, a composite financial health metric out of 9, is 1 out of 9. They've done a 1 for 50 reverse stock split to maintain their NASDAQ listing, a $75 million ATM equity offering, a $69 million underwritten offering, all within 18 months. Every time the stock rallies, there's pressure to issue more shares to fund the business. I also found something worth flagging when I dug into the earnings. In Q4 2025, management highlighted their D2C marginal unit contribution margin up 28%. In Q1 2026, when volume jumped 89%, that metric quietly disappeared from the report. When volume grows but margin metrics vanish, it usually means volume was bought, not earned. I know all of this, I'm buying calls anyway. Here's why. The bear case is a 12-month story about cash burn and dilution. My trade is a 6-week bet on a technical bounce from macro stabilization. Those are different theses on completely different time horizons. And I size this at $31,000, which I can afford to lose in full if I'm wrong. That's the discipline built into the speculation. Here's exactly how I'm thinking about the exit. I'm not targeting my break even of $32.47. I don't need a home run. My target is BETR at $28 to $29. When it gets there, I sell the calls before expiration, while time value is still working. Then I rotate the proceeds into BETR shares. Why shares? Because underneath this short-term trade, there's a longer-term thesis I believe in. The Tinman platform is real. The Credit Karma partnership is real. The Coinbase Bitcoin mortgage is real. If BETR executes over the next year or two, I want to own the stock for that story. The calls are how I get a lower effective entry on those shares. I want to be clear. I'm not betting on a peace deal. A U.S. deal in the Middle East would be massive upside, but that's not my base case. My base case is $25 support holds, macro fear settles, pent-up demand narrative takes hold, stock bounces to 28 or 29. And if BETR breaks through $25 and my calls expire worthless, I lose $31,000. I've sized this so I can handle that outcome. The most valuable thing I can leave you with today isn't buy BETR, it's this framework. When you see a macro-driven sell-off, ask yourself one question. Did the business change or did the fear change? If the fundamentals held and the sell-off is driven by an external event that's reversible, that's where opportunity lives. I learned the hard way earlier this year that margin trading without a clear plan is how you give back everything you built. I watched my account drop from $90,000 down to $32,000. The SaaS crash hit my positions. The margin made it worse. That's real money, and that's not a small thing to lose. This trade has defined risk. I know exactly what I can lose, every single dollar of it. $31,000. 126 calls. July 17th, $25 floor. $28 to $29 exit. That's the trade. Let the numbers do the talking. And as always, do your own research before making any move with your money.